Hi everybody, my name is Bob Mathers. I'm a tax attorney with Davis & Kielfeld, based in their Oshkosh office. I'm also a CPA. I'm here today to talk about an overview of the Tax Relief, Unemployment, Insurance Reauthorization, and Job Creation Act of 2010. I'm just going to call it the Tax Reform Act of 2010. It's important for each of you to understand that this legislation is wide sweeping. It affects not just estate planners, but also business attorneys, and attorneys who counsel individuals. It has a number of different tax relief provisions. In fact, they all add up to about $68 billion of expense for the United States government. None of the revenue raisers that were contemplated by the House and the current administration made the final cut in the bill. So things like a 10-year limitation on grantor retained annuity trusts, things like the repeal of any type of valuation discount allowance didn't make the final cut. It was all reduction of taxes, and it was very short-term in nature. What you need to know really breaks down into two different areas. First, the estate tax provisions, and then second, several income tax provisions. In the estate tax area, there's a new rule for 2010, and remember this legislation was passed in December. The 2010 estate tax rules basically allow the executor to elect in or out of the estate tax. If the executor elects into the estate tax, there's a new $5 million unified credit in 2010 only. And there's also a $5 million generation skipping exemption with a 0% tax rate. The $5 million exemption, anything above that does have a 35% tax rate associated with it, which is down from the previous 50%. In addition to that, however, in 2010, you can elect out of that regime and into the 2010 estate tax-free modified carryover basis regime. There's a new form that the IRS has just put out in December. It's Form 8939. There's some articles about that on the web. That's what the George Steinbrenner estate did in New York. That will keep the Yankees in New York and will contrast his estate from that of Joe Robbie, where there's a fire sale, you may recall, of the Miami Dolphins. It was a good decade or more ago. That's sort of a highlight of 2010. 2011 and 2012 has some very unique provisions. The $5 million gift tax exemption, an all-time high. Nobody was expecting this. It was sort of an inside arrangement that happened inside the Beltway at the 11th hour of last year, 2010. Vice President Biden got together with a bipartisan committee and came out with the 2011 and 2012 tax cuts. $5 million gift tax, so a married couple can transfer up to $10 million estate tax free, 35% rates on everything above that. Again, down from the $1 million and 50% rates that we were looking at not 2 months ago. In 2012, you also have the ability to have portability that allows a surviving spouse to claim the exemption from the decedent spouse without having to do anything except make an election on Form 706. The estate tax is very important. It's wide sweeping and it's a surprise. But also important is the income tax breaks that are out there. For example, you can shelter up to $10 million of capital gains if you form a qualifying small business corporation stock and use that and hold it for a 5-year holding period. In addition to that, the Congress reinstated the qualified charitable deduction as it relates to 401k and IRA assets. If it's a trustee-to-trustee transfer, up to $100,000 per person, so $200,000 for a married couple, you can make a direct distribution from an IRA to a charity and not have to take that into income. Now, you don't get a charitable deduction either, but it's a great way for some clients to qualify their required minimum distributions for a charity and not have to take it into income. Another provision is the Section 179 election to expense. So if you have clients who are buying property, plant, or equipment, they can now expense up to $500,000. This is short term. It goes back down to $250,000 in 2012. Also, 100% bonus depreciation on top of that will allow even more deductions to be expensed instead of depreciated over a long period of time. The energy tax breaks have been extended. What's unique here is not just the government reinvigorating their ability to give tax credits and tax grants to our clients, but also the ability to transfer those benefits to lessees so that we have investors forming leasing companies creating wind energy, geothermal energy, and things like that, and taking the credits and passing them along to lessees who are involved in that wind energy or the geothermal energy. Those aren't the only tax credits. There's over 50 tax credits that were extended in the Tax Reform Act of 2010. The last provision, probably the most important, is that the individual income tax rates stayed flat. We were expecting them to go back up to 39.6% for the top rate. They are capping out at 35%. That's until the end of 2012. This basically gives clients who are thinking about the Roth IRA conversion the ability to take that a couple more years because the income tax rates are going to remain low at 35%. That's about it. That's a quick overview. I'm hoping that you actually spend some time with this new law. It's wide sweeping and it affects estate planners, business attorneys, tax attorneys, as well as attorneys who just counsel individuals. And hopefully this overview and some of the provisions in the article that I've got in the Wisconsin Lawyer will help you help your clients. Thanks a lot.